Welcome to the Broken Pie Chart Podcast, episode 162. I'm your host, Derek Moore, and with me is my co-host, Jay Pestrichelli, CEO of ZEGA Financial. Jay, how you doing today?
Derek, great to be here. Look, back-to-back weeks, I'm here.
It is amazing.
It's like a new commitment to the Broken Pie Chart, which I am committed to.
It is a new day, and our listeners will be very pleased. Are you feeling a little upside down, though, today, Jay? There's something happened this week.
Yeah, I feel a little, what's the word, inverted? Is that what
Inverted?
I'm feeling today?
Oh, you mean like the yield curve?
Like the yield curve, right. What does that mean? I keep hearing about it. What is
I mean,
can't even
okay.
think.
Yeah, and I think our listeners, Jay, at this point, probably know what the yield curve is. Of course, that's when shorter dated rates on bonds are higher than the longer dated rates. And right now, the 2-year Treasury yield is greater than the 10-year Treasury yield. And Jay, I think this is predicted 89 of the last 50 recessions or something like that. But actually, let me put it to you, though. I mean, as an indicator, if we just look at 10s minus 2s, does it mean immediate recession? Does it, how accurate it is? I know you were looking at some data recently.
Yeah, and so just for I want to hit the data in a moment. So what I think about, like, let's put it into kind of really simplified terms. This means that if you lent the government money for 2 years, they will pay you a higher annual rate than if you lent the government money for 10 years. They're going to pay you less for a 10-year commitment than for a 2-year commitment, right? And that is not the way bonds typically work, right? Longer time frame means longer risk, longer lockdowns. You should get paid more for the more risk you're taking. But when the yield curve inverts, like we have right now, you're getting paid a little more, not a lot more, by the way. We're talking like 1 or 2 basis points, I think. But you're getting paid more for a 2-year commitment than a 10-year commitment. And you go, why would somebody do that? Why would somebody decide to say, I'd rather take this 2-year commitment and get paid more versus the 10-year, right? So at this point, I don't know. I wouldn't buy a 10-year. I'd buy a 2-year, right? I'm going to get paid more for less risk. That seems kind of crazy. It's more of like, I got to ask you first, Dirk, before I get to the data. Why does this happen? Why would such a thing even exist? We're supposed to get, for more return, we're supposed to take more risk. Why is this not lining up with the market is actually a better question.
Yeah, my quick answer is it's probably 3 things. The Fed is obviously raising rates, and so they have the most control over the shortest part of the curve, everywhere from 4-week bills to, and in the 2 years definitely affected by that, but certainly the 3-month Treasury bill, things like that. The second is inflation expectations and growth expectations. So if you look at break-even rates, which measure, the indifference point between owning the nominal Treasury and owning the TIPS bond, the Treasury Inflation Protected Security, break-evens are higher on the 5-year than they are the 10-year. And so basically what that's saying is the market says that they expect more inflation over the next 5 years than years 6 through 10. And then it's growth expectation. It's the idea that when you have good growth expectations, you would expect a nice steep yield curve, meaning the 30-year pays more, and the more the difference, the delta, the difference, the separation between all these years, the better. And there's some distortions with the Fed, and we can sort of get into that. But Jay, that's really the 3 main things, Jay.
Right. It's a lot of looking out, right, in time and what you think things are worth today versus what they'll be worth in the future. So, yep. Thanks for explaining that. Maybe one of these days we'll bring up like what the 5-year 5 out or the 1-year 1 out looks like, but maybe we'll leave that alone for now. Let's talk about the frequency of this inversion, right? Because it doesn't happen all that often. You were just joking, right? It's predicted, 98 of the last 50 recessions. And I know those numbers are backwards on purpose because the theory out there on Wall Street is that the yield curve can invert and it doesn't guarantee a darn thing. But it certainly does seem to precede every recession that we've had since the 70s. So when I look at the recessions we've had in, 80, early 80, then, 90, 91, you look at 2001, you look at 2008, and I'll even throw in the COVID one, which was a quick recession in 2020. All of them were preceded by the yield curve inverting, the twos being paying higher than the tens. However, on this chart, there are also times when the yield curve inverts and you don't get a recession right away. You don't get one for a while. The one that stands out to me the most, the one that really kind of stands out to me in all of this might be, you look at 1998. In June of 98, the yield curve inverted first. Nothing happened. Then the yield curve inverted again in Feb 2020, which then we all know what happened with the dot-com bomb in 2021. So that one stands out to me. Going back to maybe even 78, we are not in the interest rate environment of the late 70s. I know sometimes we bring it up. That inverted way before the recession of 80 happened, but it did, right? So, by the way, it stayed inverted for quite a while during that time frame. So I think there's a lot you could I'm going to leave that one off the list because it's just a very different environment. But still, even that, it wasn't a forward indicator to my satisfaction. But when you look at each one of these recessions, there's an inversion before it. And I'm going to take us off topic for a second. Why should we fear recession, Derek? Like, why is it bad? What's the problem with recession when it comes to us as long-term investors? Like, why do I care there's a recession coming?
I mean, primarily it's, I think I'm going to give you a quick answer. Employment. It's, if you have people losing jobs, it removes demand, purchasing power, and revenues go down from companies. I mean, that's my quick answer. There's other things in it, of course, but yeah.
No, that's what I would say. I think that's it. People end up, hey, I don't have a job, I don't have money to spend. Corporate earnings drop. We always say this, right? Corporate earnings and interest rates drive what's going on in the markets. Well, if all of a sudden companies are not making money, their earnings will drop. And guess what? And that causes more people to lose a job, right? So all of those things kind of compound, right? I wanted to put it out there. I know people think a recession is the worst thing in the world, but it's really about jobs, and it's about your ability to spend money gets reduced, and companies, as we watch on the S&P 500 or on the indexes or in the stock market, will make less money, which could reduce earnings, which reduces price on the market. Okay, I connected all of those things together, Derek. Sorry, just kind of keeping it, keeping the flow at an accelerated pace today. Let me ask you, Derek, because you have always been a proponent of the bond market, kind of telling us something in the future, right? We got the jobs numbers today. Jobs still seem really good. The yield curve is still crossing. Like, it's like, are we getting a mixed message? Is the economy good, or is this more predictive of something, or do we think it's going to be one of the head fakes?
All the above, and maybe no. So okay. So one of the things you have to remember with the job numbers, it is a survey. So literally, they have people who make phone calls and say, "Are you currently employed? You're not employed? Okay. Have you looked for work in the last 4 weeks," or something like that? I mean, I'm oversimplifying it. And if people are if they're unemployed and no longer looking for work, then they're actually not technically part of the labor force. They're not technically part of the unemployment. So labor force participation, look, it was lower after 2008. It had started to tick up before the COVID recession, but it is substantially still lower now. And so while the rate of unemployment is low, and that's a positive thing, I would also say, we try not to bring any sort of political talk into this, but maybe obvious to me, the government had a really strong fiscal response. And when you send a pretty good percentage of our GDP out in checks and have other programs, it's always about incentives. So I think some of the incentives to, had all these things not been there, maybe employment would have picked up quicker. So, but yeah, I mean, I think it's good news, but Jay, it's also bad news because it means that the economy isn't going to slow down on its own. This is the theory. So the Fed has to go in and cause a slowdown, right?
Yeah, well, that's the fear, right? That the Fed action, and we said this also in other episodes, the Fed action could be too extreme because the job market may push them into it, and they cause a recession just by raising rates, right? That's kind of the fear. By the way, I don't think the Fed wants to deliberately put us into a recession, right? I feel fairly confident a recession is not their intended outcome. I think they could misstep and cause it, but I don't think that's. Would you agree with me, Derek? That's not their intended outcome. Put the U.S. in a recession.
I think if it was, okay, I'm going to be fair to the Fed. If their intention was to do that, they would raise interest rates to 5% right now. But, I think one of the reasons why they're doing it gradually is they're hoping some of the things, you and I aren't convinced that raising rates is going to help inflation. I think they're hoping some of the things that are contributing to inflation will work themselves out. That said, if you look at a chart of the Fed funds rate, and so that's kind of what people look at for the Federal Reserve controlling interest rates, and there's a pretty high correlation when they're raising rates. Eventually, it seems like there's a good correlation between a recession afterwards. And I know I sent that chart to you, Jay, and
Yeah,
so yeah, I mean, it's like I wouldn't be surprised if we went into a recession because of what the Fed's doing. And if this time is different, I wouldn't be surprised either because of how low we are. But I don't know.
yeah. Yeah, look, I think in this data that you're talking about. When the Fed is in a raising cycle, it is followed by a recession. I'm looking, and it typically they stop, and then the recession happens. And sometimes it takes a long time for it to happen. So I guess it's a matter of timing, and maybe that's connected, full circle back to the whole inversion of the yield curve. That it could take a while for this inverted yield curve to tell us that a recession is coming, right? Or that we actually experience the recession. So, yeah, I mean, look, the reason the Fed raises rates is to slow the economy down. Um, I get it. It's hot. And we don't want to have 8, 9, 10% inflation. I don't want to pay 10% more next year for what I'm using this year. Well, it makes it very hard for us to outperform inflation as money managers, right? And as advisors. So yeah, like we don't want that to happen. So yeah.
I'll give you the anti-recession, anti-yield curve argument, and that's 1994. Now, although the 2s and 10s did not invert, the 2-year over the 10-year, the 5 and the 10 did invert. And I don't have the data in front of me, but that has been a really good, much like the 10 and the 2, a really good predictor. And it's not immediate. But 94, the Fed was raising rates. We had just had, starting in 82, one of the greatest bull market ever started in 82. But 94, the market was really flat. The Fed was raising rates. And I remember being on a trading floor and people were saying, hey, this is getting flat. They're raising rates. People were getting bearish. And guess what? From 94 up until March of 2000, it was a really strong continuation of the bull market. It never technically inverted 10s and 2s, Jay. But everyone, I can tell you, was really bearish. And guess what? 7 years earlier was 87. So everyone still had those biases. So same thing, you pointed out in 06. 06 to 08 was a really good couple of years, right?
It was. Sure. By the way, back to your 94 example, right? The Fed funds rate went from 3 to about 6, right? So they started raising right at the end of beginning of 94, January of 94, peaks out in May of 95 at like 6, right? And you're right, no recession until 2001. Right? So there's a long time between them. So that's a good one to point out. You're right, it didn't invert. The 2s and 10s didn't invert. The 5s and 10s did, which, by the way, I want to give recognition to Derek, who properly called the 5 internally with us. I don't know. Did you say it on the podcast? Did you tell everybody you expect the 5s and 10s to invert?
I don't know. Yeah. I think we.
You want an Amazon gift card for me on that one, by the way. Congratulations.
Yeah. Well, yeah, I didn't make any other money on the thing happening. But no, it's yeah, I thought the fives and tens, and it was really a break even fives, break even tens. I kind of saw that. Jay, last thing before we transition to our other topic is, does the yield curve cause the recession, or is it something else? And I would say that each of these had their own little special reason for the recession. I mean, the government shutdowns, I mean, that's the most obvious one, the recent ones. But, right, I mean, the tech crash, the housing trouble. I mean, the last couple.
Yeah, it's always something else, right? It's always like the market is poised. Like obviously the market was not predicting the financial crisis in '05 to occur in '07. Some might have been. But COVID certainly when the yield curve inverted in August of 2019, nobody even heard of Wuhan, China. Well, I guess people from Wuhan, China. My apologies to anybody from Wuhan, China who's listening to the podcast. But like nobody even thought about COVID, right? But COVID came, boom, recession. So yeah, I'm with you. I agree with you, Derek. There's something else that causes it. It's not the twos and tens inverting that cause it, but it's the what I would say it could be the preparation for tightening within corporations and the economy were there, right? The positioning, the bias to be ready for that was probably there. And it feels like that's what's happening right now a little bit.
January of '89, by the way, the yield curve inverts. We have a recession that was technically, I guess, July of '90. But that was the first Gulf War. We had a spike in oil prices, So anyway, that's this is why we hedge, Jay.
Yeah, well, this is exactly right. Let's talk what do we do? You guys talk about inflation and recession and risk to my portfolio, and I need growth. Right. We don't know when it's coming. We don't know how it's going to come. They come in different flavors, and while they're never the same, they rhyme. So we hedge, we protect. Right. This is kind of the point of why we talk about this. If the yield curve didn't invert, Derek, would we still hedge?
Absolutely.
Absolutely. Right. You're absolutely right. It's just part of the. Listen, we both have strategies that are obviously more aggressive, but for the main core of a portfolio, we are always talking about have the protection on because you don't know when it's going to come and in what flavor it's going to happen.
All right. Speaking of flavors, the flavor of the day right now is inflation. I've heard some talk about stagflation. And I thought it'd be interesting just to discuss with you, like the idea of, okay, like why is it good or bad for companies? In the end, and over the long run, we know that when corporate earnings are growing at a really good rate, that is positive. We know that people, what they're willing to pay for future earnings, that waxes and wanes. We know that last year there was a reduction in that multiple. This year there is a reduction in the multiple. Corporate earnings are up, but what people are willing to pay for future growth is down. So just thinking about, I mean, in the end, right? I mean, a business has revenues, they have costs, and they have net profits, right? I mean, I don't think we need to overcomplicate it too much to start, Jay.
Nope, that makes sense.
So let's think about this. So inflation happens, and really, your input costs go up. So if your input costs go up, what do companies have to do, Jay?
They have to raise prices.
Simple enough. And at some point, if they can't raise prices enough to commensurate with the input cost, what happens?
We call that demand destruction.
Right.
People will stop buying, right? I just, hey, maybe I just can't bring myself to pay $20 a pound for chicken. So I'm not going to buy the chicken. By the way, chicken, I don't think it's $20 a pound. I haven't been to the store in a while, but it's not $20 a pound.
Yeah, and so far, by the way, net margins have been really good. Now we'll start to get more info and more light shine on all of this when come, I guess, next week, right? Or maybe 2 weeks when earnings really start to roll in. But net margins so far have been, and Jay, in a weird way, like inflation almost gives companies a license to raise prices. And I guess the other side of this is if people believe that prices are only going to go up, they are more apt to buy now, which pulls forward demand, right? I mean, like if you're like, oh, houses are only going to go up or cars are only going to go up. Oh, I better get a car today. I'm sure real estate agents, no offense to real estate agents, but they're probably telling their buyers, you better get in a house today, right? So, I mean, I think those are all aspects that come into play. I guess the other thing too is have you seen, I don't know if they've done it this time, Jay, but in the past, the container of like chips or something, that little raised part at the bottom that goes up, or you get less chips in the bag, even though it's the same size bag. You've seen that, right, Jay?
Yeah, I've seen it with cereal for sure. Oreo cookies, man, I don't know if they're doing it, but I remember the first time they reduced the package size. Right. Maybe this is like a weird way to I'm going to say disguise higher prices because the price is the same, but the quantity you get is less. Right. So one way or another, you're not getting the same number of chips or Oreos or pieces of Captain Crunch you used to get for the dollars you spent.
Yep. So the thing is though, it's pretty simple, I think, when we lay it out that way, of how inflation affects companies. And so if companies can't raise prices, if they can't continue to raise prices, and there comes a point where consumers are like, no. And by the way, employment is the elephant in the room here. If employment ever drops, that's a totally different shift on demand. But companies also can innovate. And there's something in economics called the production possibilities curve. Don't worry, I won't lecture you I won't give you an Econ 101 lesson. But basically it says, hey, if they get more...
There's a guy that won the Nobel Prize for that, right? The guy that wrote that won the Nobel Prize. I'm pretty sure he won the prize for that.
Yeah, I believe so. But it's one of those things. Look, if companies get more, like imagine you or I, Jay, were like, hey, we're going to come up with this thing. It's called the iPhone. And you and I are going to construct them on our own in our basement. There's only so many that we can put out. So we have to have a price that's really, really high. And what happens over time? Companies get more efficient. They have automation. They have new processes. They reduce costs. They have a new way of doing something. And I almost guarantee you, I mean, companies that are doing things, planning forward out, they're looking at ways. How can we cut corners, get more efficient, get more productivity? And so companies can do that as well. And one of the benefits of companies doing that is if price increases, the rate of change does abate, all of a sudden they have all this innovation and productivity that they get to keep. So I don't know, Jay, if you have any comments on that part of it before I kind of think about the supply.
Well, I think the perfect example on what you're just talking about how efficiency and innovation will bring prices down is televisions, right? It's the most obvious one, right? I think I just bought like a 70-inch screen TV, for like under $1,000. It might have been, and it wasn't like the 8K, quantum, whatever they got out there these days, but it was just a standard great 4K TV, and I paid less than $1,000. When I first moved to Florida in 2013, not so long ago, 9 years ago, gosh, maybe this is an extreme example. That same TV would have cost me $8,000, right? So, by the way, I still have that $8,000 TV, which, sorry, now I'm admitting it that I spent that on TV. I still love it. It's great. It's doing a good job. But my whole point is, like you said, as you create efficiencies, you can bring prices down, because the question we always get, like, well, will prices ever go back to where they were? And the answer is, for the exact same product, probably no, because it costs a certain amount to make something. Or for, I know food costs can be a little wonky there and have some variations in it based on, things like weather and those kinds of things. But, in general, prices are going to be what they're going to be until you get something different and more efficient that could bring it down. So, that's the problem with inflation, is it could stick around until you have factors that will drive it lower. And, the way things are going right now, this, let's call it, like, I'm gonna go out on a limb. It's not a big limb, but say this is more of a supply-driven inflation problem. Then we should see prices high for a little while, and that's just it could stick around for a bit.
Just thinking broadly about when I think about going back to economics 101, there's supply meets demand. And if you're driving, don't do this. Please pull over first. But if you kind of took your left hand, your right hand, your two pointer fingers and just made an X, it's the idea is that your right hand would be your demand line, your left hand would be your supply line, and where they meet is called the equilibrium. It's where supply meets demand. That's where price is at its equilibrium. When you have demand that goes down, revenues, quantities go down, and price levels go down. And generally, that's price level goes down, quantity goes down, GDP goes down. That's your classic demand-driven recession. When demand increases, basically what happens? Okay, well, price levels go up, quantity goes up, GDP is up. That's okay. That's not that bad. But what's happening now, in my opinion, is supply has decreased. And when supply decreases, the quantity goes down, meaning the amount of widgets that you're selling goes down. The price goes up. But overall, this is the model for stagflation. I'm not saying that's where we're going, and it's price up, but you're not able to sell as much, and GDP goes down. And that's what happens in the late 70s. That's what people are talking about. And in this case, we've had, in my opinion, a little bit of both demand increasing, and this is my opinion, that it's based upon the fiscal response. It's the stimulus. It's the different programs. It's also a shift from experience-based things to goods, things that have to be put on a boat and shipped from faraway places to the U.S. And so that's one of the things that they're talking about right now. And there's a couple ways you get out of that. One is, demand goes back to equilibrium on especially hard goods, but supply is able to fix itself. But that's a quick, economics 101 thing. And it goes back to Jay also, the idea that, if for companies, and going back to corporate profits, the danger for companies is that at some point, their price cannot increase as much as the price of their input cost. It causes demand to go down. But Jay, I don't know if you have any thoughts on that, but that's generally sort of the discussion. It's like, what's going to happen on the long run?
Yeah, I mean that's so. I agree with you there, Derek. And the only comment I would make here, stagflation is the environment you don't want to get into, right? Like you just said it, right? Prices are higher. There's not enough around to purchase. Inflation is definitely not your friend in that scenario, but you have no growth, right, to help. The one thing I would say that may be different now than other stagflationary periods is we seem to have a pretty strong job market. It's there's a lot of folks out there. There's a lot of opportunities out there for folks to go get work, and so the idea of stagflation pushing us into a recession, or maybe it's a result of the recession, I think is probably a little different this time. That we still have strong growth. But like you said, we start to see that peel off, and we start to see that less people are going to work and less people are earning, and that's the environment we're trying to avoid. And so, before, when you talk about the pieces of stagflation, we were always saying, yeah, okay, inflation may be here, it may be gone, we're not so worried, but growth is really strong. Okay, then inflation came up, and you're like, okay, there's the first leg of the stool, and maybe inflation will lead to GDP decline because we're going to destroy demand because prices go up too fast. Okay, corporate earnings, there's the second leg of the stool, in my opinion. And the last one, of course, would then be unemployment, a problem with unemployment. And so people can't even go to work to figure out a way to pay for their basic needs. So that's, to me, I think the first leg is absolutely in on inflation. It's not transitory. It's here. What are we talking about again for March? Potential. What are the Fed? What's the nowcast say?
It's about 8.1%. 8.1. Yeah.
All right. So again, another month. Near. Above, close to or above 8. is in. It's not passing. It's not an anomaly. So we got to watch for what does this really do to the corporate side of things and corporate earnings. We have said in the past on this that all of the pieces that were in place that drove growth the last few years, right? Low interest rates and high corporate earnings were still in place at the beginning of 2022. But now, and so we should, even though we deserved a breather, we still thought there was going to be growth in the stock market, right? But now, both of those two things are going to start to come into question. And if the Fed dings both of them by raising rates too fast and putting us into a recession, now we've taken away a lot of things that drove the market from going up the previous 3 years. I'm not saying it's guaranteeing the market will go lower, but the building blocks that drove the market to double over the last 3 years there's going to be cracks in them, right? So we'll just have to watch for that. So sorry, tying all that around to investing in the markets a little bit there, Derek. But that's kind of my take on it. It's not doomsday yet for me. The jobs market is still good. We're going to get corporate earnings. It'll be interesting to listen to what the outlook is from all of the CEOs and CFOs that are on the earnings calls, right? What their outlook is.
And so far, we haven't seen with the flattening yield curve. I mean, so there's some institutions that borrow or collateralize on the short end and then invest on the long end. I won't get into the complexities of that, but
like a bank. Or am I the wrong way?
But not all banks do that. I mean, not all.
That's true.
But that's one of them. That's what 94 we found out Orange County's pension was borrowing short, buying long, and when they inverted, that caused the bankruptcy of 1994 in the OC, as they say. But that's the other thing too, is there's some distortions when you get this yield curve flattening, yield curve inversions about collateralizing different operations. So we'll have to see about that. But you said the good news is that, and we'll get a really good look at earnings. The expectation is earnings are going to be up, I think, about 8.8%. I think Bob Pisani was on CNBC, and I think that's what the consensus is right now for 2022. So earnings growing is good. That's really good. And especially net margins have been the highest they've been in decades. Also really good. And the good thing is we don't have to pick market direction, Jay. We just buy and we hedge as the primary thing. So I do wonder, by the way, people like your son, are they getting calls from like the unemployment office being like, hey, are you employed? Like, are they really capturing those people? I mean, come on.
Well, he's 17, so I hope they're not calling him for it. He would test badly in that phone call. But I don't know. Like, I know there's always been a lot of listen, I think you were insinuating that, the unemployment number, isn't a real reflection of what might be going on. But but it's consistent, right? It's consistently correct. Inaccurate. So you watch it for trends, right? So I'm not, so while you're right, I also got to say, they're trying to keep it. It's the same inconsistency, and so it's trends that we're trying to infer from the data, right?
Yep, I think they call like 80,000 or 100,000 households and this and that. So
I've never got the call.
Jay. What's that?
I've never got the call. They never call me.
They never call it. They never call me either. I got the only time I saw. So I worked in college. One of the jobs I worked at a Gap store. And I do remember the people from the Bureau of Labor Statistics coming in, and they were checking prices on clothing. And so they had this barcode scanner, and they would scan it. And I said, "What are you doing?" And they told me they were from the BLS, and they were building the pricing data. And I thought that was very interesting. I was like, they needed the prices of men's and women's jeans, so they went to the Gap. Just come into a store, get the prices, write it down. I don't know how they do it now, but that's how they did it back then. So. There
is this thing online now. I think you could shop online. Have you heard about that?
Oh, you're talking about the internets or whatever that is, the World Wide Web.
Yeah.
www or something like that. Yeah.
Maybe they do that now, Derek. I don't know if they're going to. I'm just teasing about that.
But before we wrap up, deflation is not necessarily bad as long as companies can get their production costs down commensurate with deflation. Like deflation means lower prices. You don't want too much deflation because you don't want people to be like, I'm not buying anything because I know next year it's going to be even lower. I'm just going to wait and sit on my money. But in general, I mean, if prices come down, more purchasing power, and if companies can maintain the margins, but that's a separate discussion, maybe for another time. So, Jay, want to thank you again for coming on today. And I think we've been getting questions about this. And I know that, both institutional advisors and also their clients are getting questions. Hopefully this will at least spur some discussion, if not understanding in their own minds. So appreciate the time today, Jay.
Yeah, I think people appreciated the lesson from the professor, Derek. And if somebody wanted to get in contact with you, how would they do that?
Oh, yeah. Thank you. It's derek.moore@zegafinancial.com, derek.moore. And that's Zega, Z as in zebra, E as in Eddie, G as in George, A as in Apple. Financial is up to you to spell correctly, and be happy to go over how we invest, how we develop portfolios, or if you just have a suggestion for a future episode that maybe Jay will be on, maybe not. I don't know. We'll see. We'll see what happens next time. So, Jay, thanks again. And of course, www.zegafinancial.com is a place to check out more information. So I think we'll call it there, Jay, and we'll be back in a future week. Thanks, Jay.
Hopefully soon again. We'll see if I can do 3 in a row.
There you go. See you, Jay. Bye.
Bye.